If you have listened to all or almost all of my mining stock education lectures or my case study lectures going over specific mining companies or specific mines, you will hopefully begin to realize, or maybe you're more advanced in learning how to invest or trade or speculate in mining stocks, that mining is a very difficult business. And I'm going to talk about how over time, over longer periods of time, especially in the last couple decades, that it's actually gotten even harder. And a lot of that has to do with rapidly falling ore grades and the inability of mining companies to be able to permanently lower their production costs. So miners can temporarily lower their costs for a certain amount of time. There's things that they can do to slash costs to the bone, but ultimately they cannot permanently cut costs. And the reason I'm doing this lecture is because there was a comment with a listener under one of my videos arguing with me that mining companies, the cost for gold and silver miners have not really risen that much in the last 10 or 15 years. And I can tell you 100% that it is not true. Okay, and this goes back to the fact that a lot of this has to do with two main battles that miners are facing. It is a constant uphill struggle for a lot of these producing mining companies, a constant uphill battle against. First one is depletion, which they have to replace economic mine reserves that were economic when they mined them with new economic reserves. So if it's a new mine, and remember I talked about how often a lot of these miners they only have like a 10-year reserve initially, and they're waiting for that operating cash flow from that new mine once it achieves commercial production to reinvest into their mine and get that exploration upside. And that's one of the big upsides that you can get investing in a mining company and a mining stock, is if they have a new mine that they can drastically expand production and cash flow, the mine share gets re-rated, and then also new reserves are found. Well, if that mine has been producing for a long time and reserves have already been expanded by 10 years, 20 years, 30 years, it is not always easy to replace those reserves, especially if that mine has been running a long time. So depletion is a constant enemy for a producing mining company, especially if they're producing a lot of copper, producing a lot of silver, producing a lot of gold. The other major thing, and this is a industry-wide problem. Now, there are exceptions to this rule. So there are mines that there's big discoveries, or occasionally, and these are like, the odds are greater than 1 in 100, where a geologist can go out and find a high-grade, low-cost, long-life mine like a Hadmaden in Turkey, or a Juanicipio, which is the large silver mine in Mexico, which may run for over 100 years at 400 grams per ton, which is the average grades of silver. I've seen projections there from geologists that they may have over 1 billion ounces of silver there. So that's like a once-in-a-generation 30 or 40-year mine now, especially considering how difficult it is to find silver mines of that caliber. And the other mine is Fruta del Norte for Lundin Gold. So the average grades for Fruta del Norte in Ecuador are 8 grams per ton. Those are the average grades. So that is a very high-grade mine. So in the past, and we're talking like 15, 20 years ago, you could go and find mines that had 8 grams per ton, 10 grams per ton, 12 grams per ton gold throughout the entire deposit, not a couple drill holes, but throughout the entire deposit, or the majority of deposit, like basically average grades for 8 grams per ton, between 8 grams per ton and 14 grams per ton, a lot higher. But guess where we are now? We are now, for the majority of gold mines, we are barely at 1 gram per ton gold. Okay, that is how bad things are. Now, there are economic mines at 1 gram per ton gold, but it is a different type of mining. It is not the underground, high-grade, narrow vein that a lot of mine companies used to do. So the open pit mining was more adopted industry-wide, I would say end of 1990s, early 2000s, and it was out of necessity. Because grades were declining for the high-grade narrow vein, there just wasn't as many good mines. And for the industry to maintain gold production levels, they had to switch to this open pit mining. And The open pit mining brings a different set of challenges. The picture I have there, that is an open pit. So you're looking at an enormous amount of digging out of the earth, and you're constantly using those enormous earth mover caterpillar trucks. Those things are super expensive to buy. They're super expensive to maintain with their truck tires. At one point during the gold bull market before 2011, I think those truck tires, the prices on those per tire went from $5,000 per tire, I think, up to $40,000 per tire. So the costs on those are high. But you can, at scale with the open pit mining, you can make a good return if you know what you're doing. But normally the upfront costs for the open pit mining are extraordinarily high. So you can't build normally with an open pit a little mine. There are some, but most open pit mines are extraordinarily large. The open pit heap leaching operations. And you're also using an enormous amount of oil and diesel, petroleum products, and chemicals. And with that 1 gram, I have to put this in perspective. With that 1 gram per ton gold grades or 2 gram per ton gold grades, most large open pit gold mines with a base metal byproduct are not even 2 grams per ton gold. Let's put this in perspective properly. So you are trucking, you are mining and then trucking to the mill to grind down 2,000 pounds or 1 ton of totally uneconomic rock just to get 1 gram per ton of gold. So it is extremely inefficient overall to have to do that. Okay, and that's the dearth of quality gold mines that are available. Now, there are some open pit gold mines that have pretty good project economics that can have all-in sustaining costs below $1,000 an ounce. But at a certain point, these things are going to be, a lot of these mines are going to end up being in the Yukon. They're not going to be near power. Barrick Gold got in trouble years ago for trying to do one of these mines up in the Andes Mountains on the Argentina-Chile border, Pascualama. And they wasted, I think it was one of those money pits, a sunk cost. They, I think, wasted over $6 billion. It might have been over $8 billion trying to get that mine up and running. And I think they've written it off for now. So the grades are down a lot. Steve St. Angelo over at the SRS Rocco report, he covers this extensively. And while I may not agree with him on everything, I think there is no one else in the industry, in the gold community, who covers the falling of grades for free at least. There are like geologists and other professional investment bankers who cover these things, but out in the free space, he does an extraordinarily great job of tracking grades. Now, these ore grades for gold miners, primary gold miners, and primary silver miners, they may fall a little bit every year or every couple years. They may fall a little bit. I've seen some research reports out there that they fall like 1% to 3% every year, every couple years. But the really big hit, and in my opinion, based on my research, the really big damage to the mining industry is over like 10-year periods, 15-year periods. So the longer you look over time, the more the ore grades have fallen. So like 15 or 20 years ago, it was pretty darn common to find 6 grams per ton gold over a large amount of deposit for an underground gold mine, 8 grams per ton, maybe even 10. And during the 1970s gold bull market, I think the average gold grades were between like 15 grams per ton gold and up to like 20 something, 25 or 30 grams per ton gold. They were in that range. And in today's environment, there are very, very few gold mines that have those types of average gold grades throughout the entire deposit. Fosterville has those grades on part of their deposit and even better. But Fosterville, as I talked about in my lecture on Fosterville, is a really big exception to an industry-wide rule. Because Fosterville was actually a very shitty gold mine, and they did exploration drilling below the mine and got lucky and found just extraordinary grades, and the infrastructure was already there to mine the gold below the existing mine, and that allowed them to not have to spend a bunch of costs to expand the mine and mine that much higher grade gold. So if you're gambling and betting that you're going to find another Fosterville, I'm sorry to say the odds are incredibly against that happening. For most mines, the longer the mine is producing, the odds of finding higher grade are much, much lower. So Fosterville, like I said, would be the exception to the rule. For silver grades, like a project like Juancipio that I said is like 400 grams per ton, silver grades in the hundreds of grams per ton, average grade for a silver deposit used to be very, very common decades ago. 10, 15, 20 years ago, you used to be able to get good grades like that. Nowadays, you're looking at a lot of silver projects with grades below 100 grams per ton, and it's falling rapidly. So if you only look at grades like every 1 year, 2 years, or a couple years, you're not going to necessarily see a massive fall off in grades. The big grade drop is going to be over 7-year to 10-year periods or longer, the longer you look out. And in my opinion, what this means is that the cost curve for the miners, the cost cannot permanently be lowered. So the miners, like I said, are fighting an absolutely difficult uphill battle to try to cut costs when the material, the ore that they're mining economically, the grades are routinely falling, hurting their margins. So there will be some exceptions to the rule. Occasionally, there will be an amazing find of a gold deposit or a copper deposit or a silver deposit, something along those lines, but it will be an exception to the rule because overall industry-wide the grades are declining, and this makes it harder for the industry to grow production and replace reserves and maintain margins. So the industry overall is wasting a lot more money on energy, on chemicals, than they would have had to in the past, and that hurts margins too. So the industry has to move, like I said, 2,000 pounds or a ton of uneconomic ore, and then after they crush it, they have to, because it's with chemicals, they then have to, in the tailings dam, they then have to store it environmentally safe in a tailings pit. So those are a bunch of added costs to the mining industry that I think a lot of people that are saying mining costs have not materially risen don't understand. Okay, I talked to anyone in the industry who has a decade or more experience, and they will tell you, ask them about stories about gold grades in the past, silver grades in the past, copper grades in the past, and see what they have to say. So there's a, before I wrap this up, there's a very interesting thing also to talk about called the, I doubt most of you guys are aware of this. It's called the Simon Ehrlich wager. So I don't agree with everything that this guy Paul Ehrlich says, this biologist, but the Simon Ehrlich wager, I'm reading the Wikipedia page, describes, and it's tied into this lecture, describes a 1980 scientific wager between business professor Julian L. Simon and biologist Paul Ehrlich, betting on a mutually agreed upon measure of resource scarcity over the decade leading up to 1990. The widely followed contest originated in the pages of Social Science Quarterly, where Simon challenged Ehrlich to put his money where his mouth was, in response to Ehrlich's published claim that if I were a gambler, quote, if I were a gambler, I would take even money that England will not exist in the year 2000, end quote. Simon offered to take that bet, or more realistically, to stake $10,000 on his belief that the cost of non-government controlled raw materials, including grain and oil, will not rise in the long run. Simon challenged Ehrlich to choose any raw material he wanted and a date more than a year away, and he would wager on the inflation-adjusted prices decreasing as opposed to increasing. Ehrlich chose copper, chromium, nickel, tin, and tungsten. The bet was formalized on September 29, 1980, with September 29, 1990 as the payoff date, so a full 10 years. Ehrlich lost the bet as all 5 commodities that were bet on declined in price from 1980 through 1990, the wager period. So Ehrlich also wrote The Population Bomb. He was on Johnny Carson, I think in the 60s and 70s, predicting that Miami would be underwater. So like I said, I don't agree with everything he said, but his timing was way, way off on this bet. But now, especially over the last 10, 15, 20 years, we are seeing a lot of the stuff with the metals, the energy and resource scarcity start to come to fruition. So there is no longer really, really cheap oil. There is no longer really, really cheap copper to mine. The days of 50 cents to mine copper are gone. The days of mining gold below $600 an ounce, there are a few exceptions to that rule. There are a few deposits that can be economic of gold. But if gold prices were to go crash and go way below 1,000, most of the miners would be bankrupt, and the production of the gold would have to drastically decline. There are just very few, if any, deposits that can be mined economically at lower metals prices. So there is still, the earth is finite on resources and metals, and everything that's not grown has to be mined or recycled. So the metals, you're not going to see cheap metals for a very long period of time unless demand collapses. As long as demand maintains steady levels or demand increases, you're not going to see cheaper variations. Now, in the past, over that 10-year period on that bet, he was too early. But now you're not seeing cheap copper anymore. You're not seeing copper at 50 cents per pound. You're not seeing silver at $4. You're not seeing gold at $400 an ounce or $600 an ounce. It's just not economic. And the more supply that has to come online, there's no magic bullet or silver bullet or panacea that's going to magically, permanently, or at least for a very long period of time, many decades, substantially lower mining costs by 30% or more. I just don't see it. The mining industry is normally very, very skeptical and apprehensive of switching to a lot of new technologies. The open pit mining that was switched to, I think, out of necessity in the late 1990s and 2000s, a lot of people back then even questioned that. But there was no way to grow gold production levels and copper production levels without actually switching to more open pit mining and the heap leaching. So there's a lot of research out there. Steve St. Angelo has talked about this extensively. There's a lot of articles that he covers for primary gold and primary silver miners, also copper miners. Chris Martinson of Peak Prosperity has also talked about this. He's talked about the drastically declining copper grades over the last couple decades, the drastically declining gold grades, the drastically declining silver grades, and how a lot more energy is being used to mine. So I don't see that trend changing anytime soon unless demand for metals were to drastically decrease. And I don't see that happening either. Now, maybe because a lot of base metal demand is from China, maybe if China does slow down, their demand would drop. But as of right now, I don't see that. I said not to buy Hecla. I was warning people to stay away from Hecla. I'm sorry you lost money on Hecla. I was telling people not to buy Hecla. There was one troll who was telling me that he was going to make all this money at Hecla, and I was like, good luck to you, Godspeed. I was like, I would not buy and hold that stock. He was like, oh, I'm going to make so much money on Hecla, and it did go up temporarily, but they have to raise a lot of capital. They have balance sheet problems. They have production problems at mines that are going to be very expensive to fix. So the bottom line is, based on the research, that there is a lot lower grade ore to mine now than there was 10 years ago, 20 years ago, 30 years ago. And that means, in my opinion, that eventually mining costs go higher. So it doesn't necessarily happen right away. Maybe the miner can figure out ways, like was mentioned here in the chat section, to totally eliminate exploration budgets. So that is one of the ways miners can cut costs. Miners can also high grade. They can destroy the long-term project economics at their mine by only mining the high grade to survive and not go bankrupt. But then normally, if you're not familiar with a mine, normally what happens is, depending upon metals prices, they have in the economic projections for the mine to mix in like a little bit of marginal grade ore, depending upon the metals price, with their solid ore, which is just the average grades, and then their high grade ore. So if they only mine their high grade ore, which are the best margins, it's stockpiled in different areas. So if they only, and then it's mixed in and crushed and separated that way. So if they only mine the high grade ore, that means then that over the long term, the project economics of that mine, so 5 years, 7 years, 10 years from now, are going to be much, much worse, because they won't have that high grade left to mine to mix in with the average grades of the ore and the lower grades, the marginal grade ore. And that's what a lot of miners have done, unfortunately, to survive the bear market in gold and silver. Although now it looks like that the gold and silver bull market is going to start restarting, especially for gold in the near future. But like I said, a lot of these producing miners, they have bad balance sheets. and they're going to need to go to the capital market soon to raise a lot more capital. We've seen small capital raises. I don't think we've seen any big capital raises yet of well over $100 million. I don't think I've seen a press release on one of those yet, but we will. We will. It'll probably be if metals prices stay at these levels or go higher, we will see big capital raises of $100 million or more by a lot of the mid-tier producing miners and some of the senior miners. So if you have research that doesn't agree with anything I said here about the ore grades, you can go ahead and send it to me later, but I would dispute it. Because the Homestake Mining and Dome Mining, which were the two main primary gold miners when FDR devalued the dollar against gold, when he devalued the gold price from, well, he devalued the dollar and the gold price went up from $20 an ounce to $35. The mining companies back then, because there wasn't massive declines in ore grades back then, the gold mining companies, their margins exploded higher. So those mining stocks did superbly. So the price of gold went up and their costs didn't soar. So they had enormous growth in revenues, earnings, free cash flow, and dividends. And a lot of that same stuff also happened too in the 1970s. You did not have... so the grades for a lot of the gold miners in the 1970s were lower than in the past, but their costs did not go up super high during that gold bull market of the 70s. So, and they had much higher gold grades than they do now. And that's why if you talk to people that were around during the 1970s gold bull market, that's why you had an explosion in earnings and free cash flow and dividends for some of those mining stocks back then. Because the miners back then did not have to deal with 1 gram per ton gold, where their costs were going to be rising every couple years. Or they were worried about their grades dropping 10% over a 5-year period. Oh, I'm glad Sean and Ascorz, ASCORZ 11. I'm glad you like my work. I appreciate it. Sean says you've been in the resource mining industry for 6 years, lead, zinc, silver, copper, and gold mines, and for your 6 years in the industry, you've seen massive cost cutting to the point of neglect. Yeah, that's a dangerous thing. So you cut costs to the bone to survive, but then you've cut corners. So you haven't spent money on exploration. You haven't spent money on upgrades at the mill. There's a lot of important CapEx, maintenance CapEx, and growth CapEx that the miners have neglected to survive or neglected out of necessity. Jack, we've had, there was a period, Jack, for about 2.5 years, almost 3 years, where there was almost $0 spent on exploration. And that's why you saw a lot of these junior miners basically switch to marijuana and crypto, the shell companies, because they couldn't raise any money. Yeah, so over the longer periods of time you look at for mining companies, the more difficult it is for them to maintain their margins, because it is very difficult to find high grade projects now with good margins and to lower costs over the long term. Very, very difficult. So the industry, this is why the industry struggles so much. Because number one, you have depletion. Number two, the metals prices have not done well for a while. Although we've in foreign currencies, gold has, but in dollar terms, they have not. And then the mining companies are dealing with all these issues at the mine. So gold and gold mining stocks will diverge. No, not necessarily. But it just means that the gold mining stocks cannot perform very, very well, Philip, for a long period of time because they have enormous operational problems at their business. Not every mining company is going to have to deal with the same amount of problems. So if you, this is a danger, this is not financial advice, this is a danger of buying individual mining stocks. The miners do struggle due to the gold price suppression, but the miners also struggle because the majority of gold mines are just not very good. So for every Fosterville or every Fruta del Norte or every Hot Maden, which will be online in Turkey in a few years, for every one of those mines, which are very, very good, there are dozens, if not hundreds of mines that are higher cost, lower grade, and very, very marginal. The old grades from the 1970s of well over 10 grams per ton gold that could make very big margins, there are very few of those mines left. And this is what, Philip, and this is why I prefer royalty and streaming companies. They don't have to deal with any of these issues. If they have one royalty or one stream that goes bad, if they're large enough and have diversified sources of cash flow, it's one bad deal. Or hopefully they've reinvested profits and free cash flow from their diversified portfolio of cash flow assets into other investments. And so one deal that goes bad or one mine that stops producing doesn't kill the company. The miners have a lot of environmental costs that they have to cover now that they did not have to cover in the past as well. That is a good point, Jeff. So there are a lot of environmental costs. And the other thing is the mining companies now, there are a lot of mining unions in a lot of countries, not just the US, but you also have mining unions in South Africa, mining unions in South America, that even if metals prices are down, they are constantly demanding higher wages. And the mining company can't afford it. The mining company is about to go bankrupt. The mining company has a bad balance sheet. The mining company has little or no margins. And you have the miners' unions who don't care and are demanding higher wages anyway. So the mining company, this is why you did not necessarily have as many of these problems in the past with the miners' unions. But in a lot of countries now, the miners' unions do not care if the mining company has no margin, they have a bad balance sheet, and the mining company is on the verge of bankruptcy. And they're still demanding higher wages. This was case in point. This is example for a lot of gold miners and a lot of platinum and palladium miners in South Africa. The platinum and palladium miners, there was a bear market for a long time before palladium prices went crazy. There was an enormous bear market. Platinum and palladium crashed. And so a lot of the platinum and palladium mining in South Africa was very uneconomic. And you had all these mining unions there demanding higher wages. Well, the miners are about to go bankrupt. They have no margins. Their balance sheets are shot to shit. So it's the mining industry has so many difficult challenges and problems to deal with. This is why you will not see a lot of value investors want to go into mining. A lot of value investors have read that Seth Klarman Margin of Safety book, and they're well aware of the maintenance capex problems for mines that miners constantly have to deal with and they don't disclose. So it is a never-ending fight for the miners to figure out how to cut costs even a little bit. But it's an uphill battle because if their ore grade declines more, even if they cut costs in one place, their costs are going to go up on their ore grades. Their margins are going to fall, and they're going to have to mine more uneconomic rock just to get some ore that's economic. So the analogy I would use for mining companies is basically it's like one of those cartoons with like Daffy Duck or one of those other Looney Tunes characters where there's all these holes in the boat, and you have Daffy Duck or one of these other cartoon characters, using their beak, using their legs, using their arms, trying to plug all these holes, and another hole in the boat just sprung a leak. What's the best producers of gold right now or silver? Jesse, which one are you asking about? Which metal? Thank you for the super chat, Jesse. What metals are you talking about? Mining asteroids, I don't think mining out. I'm in my mid-30s. I don't know if we'll see mining asteroids in my lifetime. And the costs for those are going to be insanely high. There will be high-grade copper, high-grade platinum group metals, high-grade gold on those asteroids, but the costs for those are going to be astronomical. I expect probably in the next 10 or 15 years, we will see mining on the ocean floor and lower. So there are 10% copper grades there. There is over 10 grams per ton gold grades. There is silver grades of in the 100 gram per ton or more range on the ocean floor or lower, and I expect we will go there. There's only one company that's even thinking about doing this right now. It's Nautilus Minerals. It is a penny stock. Nautilus Minerals is a penny stock. It is a big speculation story. I don't know if I'd buy the stock because I'm not sure if they're ever going to get the environmental permits to actually mine. Even though the grades are really, really high on the ocean floor, I'm not sure if they'll ever get the environmental permits to do it. Okay, so this is just my opinion, not financial advice. Jesse wants low-cost gold and silver producers. So for silver producers, the low-cost ones with the best margins are Pan American Silver and First Majestic Silver. I think they're in good shape. There are some smaller ones like Fortuna and some others. I really like Mag Silver. They're not producing yet. Their mine's under construction. Fresnillo, which is the world's largest silver miner, is their partner, their joint venture partner at the Juancipio mine in Mexico. And that mine has 400 grams per ton silver, and the mine plan for now is like for many decades. So I like MAG, M-A-G, Mary Alex Gregg Silver. I think that is a good speculation play. Again, not financial advice, just my opinion. For gold miners, I don't like a lot of the big ones. I don't like a lot of the big ones like Barrick Gold. I think there's always too many problems there. Like Barrick Gold, I did a video on this about 1.5 years, 2 years ago. I think 1.5 years. And I went through how Barrick Gold was drastically understating their costs. They were telling everyone their all-in sustaining costs were below 800, and I ran the numbers and compared it, and that their real all-in sustaining costs were $1,100 an ounce. The new CEO doesn't want to be there with the merger after Randgold Resources. He doesn't want to be there. They announced a 5-year restructuring plan. Now, these stocks like Barrick and stuff, if the gold price keeps going up, they can go up, okay? But I'm talking about the fundamentals, the underlying business. They have a lot of problems at their underlying business right now. I think a lot of these primary gold miners are going to be raising capital soon. So I would watch that. You might want to wait until after you see some capital raises. Some of them are going to be raising a lot of capital. You've started to see small press releases for a couple $1,000,000 for a junior up to, I think 50 million for some of them. I prefer the royalty and streaming companies, though, to the actual mining companies. Because the royalty and streaming companies have more diversified cash flow. They don't have to deal with all these enormous challenges of actually doing the mining and the grades and stuff. They just buy royalties or streams, and they're more diversified. And I think the royalty and streaming companies are as good or better than owning a gold mining stock ETF or a silver mining stock ETFs. For producing gold miners, I think this is more speculative play, but I would stick with grades here. I really like Lundin Gold and the Fruta del Norte project. I think that has a chance. That project has a chance. The stock has already gone up quite a bit because the mine is like 73% constructed. I think that has a chance to be some of the best margin producing gold because of the grade. So, and once that mine is at commercial production, what they're going to do, hopefully, is take that operating cash flow and plow it back into the business at the mine on exploration drilling, and they could have big exploration success. So there's a good probability that that mine life could be expanded a lot longer than 11 years, and they have 8 grams per ton gold. So it's a very solid project. The whole mine has average 8 grams per ton gold now, the whole reserve. So this is not where, they did a couple drill holes and a part of the mine has 8 grams per ton. No, the whole average grades of the mine is 8 grams per ton. And I think they have a very large land package. Sandstorm Gold has a royalty for Fruta del Norte, so Sandstorm Gold will ride along a little bit. They're going to get a small amount, a couple $1,000,000 per year in cash flow, but they will participate in the exploration upside if Fruta del Norte does get big exploration successes with the drilling. Jesse, thanks again for the super chat. There's a couple super chats today, Jesse. I appreciate it. What's the best royalty companies? I only like the 5 largest ones because you have to be at a certain scale for the barriers to entry. So I wouldn't buy anything smaller than Sandstorm Gold. I think Osisko Gold Royalty is still pretty cheap. They have underperformed relative to the other royalty and streaming companies. They have 3 really good cash flow royalties that are large that would interest the larger royalty and streaming companies in an acquisition. So I think Osisko is pretty cheap. I think Sandstorm Gold has more growth than any other company, but Sandstorm's gold stock has gone up quite a bit. It's still undervalued, but the stock has gone up quite a bit. If I had more money coming in, if I was actually making a better living from all this content, I would be buying more in dips. But I just don't have a lot of money coming in right now from the content I make. A lot of things in my life have not gone as planned, unfortunately. So you have there's only a handful of large royalty and streaming companies in precious metals. You have Franco-Nevada, you have Wheaton Precious Metals, you have Royal Gold, Osisko Gold Royalty, Sandstorm Gold, and then Mavericks Metals. Mavericks Metals just listed, I think, on a regular exchange. Wheaton Precious Metals has had a lot of silver deals with partners that have gone bad. So those silver deals that they did, a lot of them went bad with the smaller miners. They bought a lot of silver byproduct, and that's doing fine, but the deals that they did with primary silver miners, a lot of them have all gone bad in the last 4 or 5 years. When there's blood in the street, buy juniors. There's so many bad juniors though, and so much fraud. I mean, unless you really know what you're doing, it is very difficult to tell. Unless you have a good paid newsletter with a geologist that's screening some of these things, there is so much fraud in the junior resource space. So many newsletter writers that are being paid to pump a stock and not disclosing it. I can't name names, but there's a lot. At one point when the gold price was going, it was 40% of the junior mining newsletter guys were on the payroll, on the dole. They were getting something from the company and not disclosing it. And I suspect that will happen again. Thomas says the miners struggle due to the gold price suppression. That's the main cause. No, it's not just that, Thomas. Mining is a very shitty business. They cannot generate sustainable margins and permanent free cash flow. There is a lot of maintenance capex, and the miners lie about their costs. They cut on capex bills, and they really, really struggle to find higher grade ore to maintain margins or improve their margins to grow more free cash flow. So the miners struggle not just because of the gold price suppression. Even if there was no gold price suppression, the miners at some of their mines would still have big problems. The gold and silver price suppression has just exacerbated the problems to the point where some of the miners were close to bankruptcy. Philip says, why do they bother mining if it's so tough? Well, a lot of these guys are getting paid to do it. So a lot of these guys don't like gold or silver. They don't care if it's manipulated. They're getting paid a salary to be a geologist or to run a mining company, so they mine. And then there's still demand for the metal. So they're going to do it as long as they can raise the capital. Some of these guys are grossly overpaid who are running mining companies. They destroy shareholder value. They dilute like crazy. They lie to their shareholders about costs. So as long as they can raise the capital, they'll do it because they're getting a salary and stock options to do it. This is why I don't trust a lot of gold mining CEOs. I've learned a lot. I was covering mining companies on my own and writing research reports, and I've interviewed a lot of the experts in the last 10 years. I thought the gold price would be a lot higher in the past than it is now. So my views on gold and silver have changed a bit. I've learned a lot. I studied the supply side. I learned a lot on my own, and then I had a job where I was also covering some mining companies and resource companies too. The movie with Matthew McConaughey was fascinating. Yes. Yeah, I saw that. I was the only person in the theater when it came out. Me and my best friend were the only two people in the theater. I thought it was a good movie. No one liked it, though. No one likes the fat Matthew McConaughey. Okay, guys. Well, I think that's it for right now. If you have any other questions or comments, you could put them at the end of this video, below the video. But the bottom line is that you can check out the work for Steve St. Angelo, SRS Rockwell Report. He does a really good job covering the declining grades and margin problems for the primary silver miners, primary gold miners, and the copper miners on the free side. Now, there are people who do paid research for this. I think it's mostly investment bankers and a lot of geologists that are hired by like Sprott and some of the investment banks that get the geologists that are hired by some investment bankers or hedge funds to do this stuff. There's not a lot, besides Steve St. Angelo, there's not a lot of free research that covers this stuff extensively with the falling of grades and how difficult it is to replace economic mine reserves with depletion. I think Steve St. Angelo is right about the grades. His research work is good. He shows this math. It's not like he's not showing the work he's doing. Oh, thanks, Phil, for the super chat. Okay, guys, well, that's it for now. I'm kind of getting a little tired here. I'll see you guys later.